Welcome to the Dinar Daily. An unsettling calm has been broken across the world's currency markets this morning, leaving millions of investors in a state of profound shock and confusion. For those holding positions in the Iraqi dinar or the Vietnamese dong, the numbers on the screen are nothing short of jarring. These two currencies, long the subject of intense speculation and hope for future economic recovery, have experienced a sudden and precipitous decline that has caught even seasoned market watchers by surprise. What many are already calling the 25 currency shock has sent powerful tremors from the trading floors of Asia and the Middle East to the digital forums where global investors gather. The immediate aftermath is a whirlwind of frantic social media posts and panicked inquiries, as countless individuals try to make sense of a situation that seem to develop almost overnight. Before any rash decisions are made in the heat of the moment, it is essential to pause and dissect the complex events that have led us to this point. Today, we are going to delve deep into the mechanics of this sudden market movement, exploring the fundamental drivers behind the crash and what these developments might signify for the path forward. Whether you are a long-term holder who has been following the story of the dinar for more than a decade or a newer investor who recently took an interest in the dong's growth potential, the information we are about to cover is critical. Understanding the why behind these dramatic shifts is the first step toward navigating one of the most volatile periods the global market has witnessed in recent memory, offering a chance to replace fear with a clear, informed perspective. Let's begin by examining the figures that have caused such widespread alarm. The Iraqi dinar has sustained a staggering blow, plummeting by approximately 30% over the course of the last 7 days alone. This is not a gentle correction or a minor fluctuation. It is a massive and abrupt downturn that very few analytical models had anticipated. Similarly, the Vietnamese dong, which had previously demonstrated a greater degree of resilience, has not been immune to the turmoil, shedding around 25% of its value against major currency pairs. For a significant number of retail investors, this translates into a devastating reality, a portfolio that has lost a substantial portion of its worth in what feels like the blink of an eye. Erasing months or even years of perceived gains, the immediate ripple effects of this downturn are being felt in key financial hubs that facilitate trade in these currencies. Exchanges located in Dubai, Istanbul, and Ho Chi Minh City have reported an unprecedented surge in sell orders, a clear indicator of widespread panic taking hold among individual traders. This sudden rush for the exits has created significant operational challenges, with even large-scale currency dealers reporting difficulties with liquidity as the volume of sell requests overwhelms the available pool of buyers. The situation underscores that this is a large-scale market shift, a seismic event with the power to propagate waves of instability across numerous emerging market economies, forcing a re-evaluation of risk and exposure on a global scale. The urgent question on everyone's mind is what confluence of factors could possibly trigger such a dramatic and synchronized decline. To unravel the mystery behind the dinar's sharp fall, our investigation must start with the bedrock of Iraq's national economy, its vast oil reserves. The nation's financial health is inextricably linked to the global energy market, with revenues from oil exports accounting for nearly 90% of the government's entire budget. This extreme dependency creates a fundamental vulnerability. When global oil prices are high and stable, the Iraqi economy benefits from a steady stream of income. However, the energy markets have recently been characterized by intense volatility, whipsawed by a combination of escalating geopolitical tensions in key regions and unpredictable fluctuations in global demand, creating a deeply unstable foundation for Iraq's fiscal planning and economic outlook. This instability in the oil markets directly translates into pressure on the Iraqi dinar. When oil prices weaken or become erratic, it casts a long shadow of doubt over Iraq's capacity to fund its national budget, pay its debts, and maintain its foreign currency reserves. This uncertainty makes international investors incredibly nervous, prompting them to question the central bank of Iraq's ability to defend the dinar's value and maintain stability. Consequently, a cycle of selling begins, which can quickly gather momentum. Adding to this pressure, recent weeks have seen reports of significant delays in passing the national budget and whispers of internal disagreements over key fiscal policies, further eroding investor confidence and providing more fuel for the sell-off. The combination of weakening oil prices and domestic political uncertainty created the initial conditions for a downturn, but it was another, much larger global force that turned a difficult situation into a full-blown crisis. That force is the formidable strength of the United States dollar. Following the latest policy announcements from the U.S. Federal Reserve, the dollar has surged to its highest level in years, creating immense pressure on currencies across the developing world. When the dollar strengthens so decisively, it acts like a powerful magnet for global capital, pulling investment away from emerging markets and back into the perceived safety and higher yields of U.S.-based assets, such as government bonds. This phenomenon can be visualized as a giant seesaw in the global financial system. As the side representing the U.S. dollar rises, driven by higher interest rates and its status as the world's primary reserve currency, the other side, bearing the weight of emerging market currencies, inevitably falls. This inverse relationship is a well-documented pattern in international economics. The capital flight from smaller economies weakens their currencies, increases their borrowing costs, and can exacerbate inflationary pressures. While this effect is being felt in countries from Turkey to Egypt, its impact has been exceptionally severe for the dinar and dong, as the speculative nature makes them particularly susceptible to rapid shifts in global investor sentiment. Now, let's turn our attention to the Vietnamese dong and the unique set of circumstances driving its decline. For the better part of the last decade, Vietnam has been celebrated as one of Asia's most dynamic and fastest-growing economies. It has successfully attracted enormous sums of foreign investment, transforming itself into a critical hub for global manufacturing and a key link in the world's supply chains. Many multinational corporations have established significant operations within its borders, drawn by favorable conditions and a skilled workforce. However, the recent downturn serves as a stark reminder that even a robust and rapidly expanding economy cannot entirely insulate itself from the powerful currents of global economic shocks. A significant portion of Vietnam's economic vitality is derived from its manufacturing exports, which are heavily reliant on sustained demand from major international partners, most notably China, the United States, and the nations of Europe. Unfortunately, several of these key markets are currently facing their own economic headwinds. The recent and pronounced slowdown in China's economic growth, coupled with a reduction in new orders from Western economies grappling with inflation and slowing consumer spending, has directly impacted Vietnam's export volumes. This softening of export growth has been a major contributing factor to the pressure being exerted on the dong, as it signals a potential slowdown in the flow of foreign currency into the country. Compounding the issue of reduced export demand are the rising inflationary pressures within Vietnam's domestic economy. The cost of living has been climbing, putting a strain on households and businesses alike. In response, the State Bank of Vietnam finds itself in an incredibly challenging position, attempting to perform a delicate balancing act. On one hand, it needs to support economic growth and maintain employment levels. On the other, it must combat inflation to ensure price stability. This task has been made exponentially more difficult by the aggressive series of interest rate hikes enacted by central banks in the United States and Europe, which limits Vietnam's own policy options and contributes to the downward pressure on its currency. This confluence of external and internal pressures has created a challenging environment for the dong, and the pain is now being acutely felt by investors who had bet on the continuation of Vietnam's unbridled growth story. Faced with this sudden and sharp decline, many retail investors are now grappling with a critical question: does this event signal the end of the road for their investment thesis, or could it, paradoxically, represent a new, albeit risky, buying opportunity? Historically, both the dinar and the dong have been viewed through the lens of long-term potential, with the belief that their values could appreciate significantly as their respective economies stabilize, modernize, and integrate more fully into the global system. However, the kind of short-term volatility we are currently witnessing injects a tremendous amount of confusion and fear into the market, making rational, long-term thinking difficult. Some market analysts are suggesting that such dramatic drops, while painful, are not necessarily indicative of a fundamental failure of the underlying economies. Instead, they can be viewed as natural, if severe, corrections within highly speculative markets that were perhaps overdue for a reality check. Nevertheless, it is absolutely crucial for anyone involved to remember that trading foreign currencies is a fundamentally different endeavor than investing in stocks. Currencies do not pay dividends or generate earnings. Their value is derived purely from price movement, which can be swift and unforgiving, while retail investors grapple with emotional responses. A very different scene is playing out behind the closed doors of institutional investment firms and hedge funds. These professional traders are not reacting with panic. Instead, they are approaching the situation with methodical calm, closely monitoring a specific set of key data points that will inform their next moves. Their screens are not just filled with price charts, but with real-time information on Iraqi oil production levels, inflation trends in Vietnam, and, most critically, the US dollar index, which measures the dollar's strength against a basket of other major currencies. These sophisticated investors operate on the principle that moments of short-term panic often create opportunities for long-term, strategic positioning. They are fully aware of the immense risks involved, but they also possess the resources and analytical capabilities to look beyond the immediate noise. For instance, they are tracking the slow but steady improvements Iraq has been making to its oil infrastructure and its ongoing efforts to negotiate more favorable international trade agreements. Simultaneously, they are analyzing the persistent trend of multinational companies diversifying their supply chains and shifting manufacturing capacity out of China and into countries like Vietnam. Both of these underlying narratives suggest that there is still a credible case to be made for an eventual recovery. However, these professionals are under no illusions that such a recovery will be quick or easy. Let's delve deeper into Iraq's current economic position to gain a more nuanced understanding. Despite the persistent political tensions and security challenges that often dominate headlines, the country's oil output has been on a gradual but consistent upward trajectory. The Iraqi government has been channeling resources into increasing the efficiency of its existing refineries and expanding pipeline networks to facilitate greater export volumes. In theory, these fundamental operational improvements should provide a degree of long-term support for the dinar's value by ensuring a more reliable flow of revenue. These efforts represent a tangible step towards maximizing the potential of the nation's most valuable natural resource. However, this positive momentum is constantly counteracted by the major structural deficiencies that continue to plague Iraq's economy. Pervasive corruption remains a significant drain on national resources and a major deterrent to foreign investment outside of the energy sector. Furthermore, the overwhelming dependency on oil revenue creates a perpetual state of vulnerability. Any significant slowdown in global energy demand, whether driven by an economic recession, a shift in geopolitical alliances, or the accelerating global transition towards renewable energy, has an immediate and direct negative impact on Iraq. As the global energy landscape continues to evolve throughout 2025, this unpredictability weighs heavily on the dinar's prospects. Vietnam's outlook, while shaped by a different set of economic factors, is no less complex. The most pressing domestic challenge is the steady climb of inflation, particularly in the essential categories of food and energy. This has a direct impact on the daily lives of its citizens and the operational costs for its businesses. The government's primary tool for combating this is to tighten credit and slow down spending. But this approach comes with its own set of consequences, as it can stifle the growth of small businesses and reduce overall consumer demand. potentially tipping the economy towards a slowdown. This policy dilemma creates significant uncertainty for the future. Early economic data from 2025 has already indicated a noticeable deceleration in export growth when compared to the impressive figures from the previous year, reinforcing investor concerns. The international community is now watching closely to see how Vietnam's leadership will navigate this treacherous path. Will they choose to loosen monetary policy to re-stimulate growth at the risk of fueling more inflation? Or will they maintain their strict anti-inflation stance, potentially sacrificing short-term economic expansion for long-term stability? The choice they make will have profound consequences for the value of the dong. On a more positive note, the long-term industrial momentum, driven by foreign investment in technology and manufacturing, could provide a stabilizing force for the currency once the current global turmoil subsides. So, what does this complex and rapidly evolving situation mean for the ordinary individual holding these currencies? The first and most critical principle is to resist the powerful urge to make decisions based on fear. Sudden, sharp drops in value are emotionally taxing, but acting on that emotion by selling into a panic often serves only to lock in losses permanently. Instead, this moment calls for quiet reflection and a reevaluation of one's original investment thesis. The key question to ask is whether the fundamental, long-term economic reasons that initially justified the investment have been irrevocably altered by these recent events. For many, the core belief in the long-term potential of Iraq's reconstruction or Vietnam's industrialization may still hold true, even in the face of this severe short-term volatility. However, if an individual's personal financial situation has changed, or if their tolerance for risk has been breached by this downturn, then a careful reassessment of their exposure is a prudent course of action. Responsible investors are using this event not as a moment to panic, but as an opportunity to review their entire portfolio, ensuring they are properly diversified and not overly concentrated in any single speculative asset class, thereby strengthening their financial position for the future. For those contemplating the idea of investing during this downturn, a heightened sense of caution is absolutely essential. While a 30% decline may appear to be an attractive discount, it is a well-known market axiom that currencies, like any traded asset, can continue to fall well below levels that seem like a bottom. Attempting to perfectly time the market is a notoriously difficult, if not impossible, task, one that eludes even the most experienced professional traders. Therefore, if one does choose to enter the market at this time, it is vital to approach it with the mindset that this is high-risk capital money, that one can genuinely afford to lose without jeopardizing their overall financial security. The objective should not be to gamble on a quick reversal, but to position oneself wisely for a potential long-term recovery. Some investors may choose to employ a strategy of buying small, fixed amounts over a period of time, which can help to average out their purchase price during a period of volatility. Others may prefer to wait on the sidelines until they see clear and unambiguous signals of economic stabilization, such as sustained improvements in Iraq's budget process or a rebound in Vietnam's export figures. Both of these are valid methods, but it is crucial to understand that neither comes with a guarantee of profit. The true skill in navigating such markets lies in patience and a deep understanding that financial markets rarely move in straight, predictable lines. It is also necessary at this juncture to address a persistent and often misleading narrative that frequently circulates within the investment communities for these currencies. The idea of a sudden, overnight revaluation that could cause the dinar or dong to skyrocket in value. These stories, which have been a fixture of online forums for years, often create a sense of false hope and can lead to misguided financial decisions. In the real world of international finance, currency reevaluations are exceptionally rare events. They are not random windfalls but are instead carefully planned and highly controlled economic adjustments undertaken by governments and central banks, usually as part of a broader, internationally supervised program of economic reform. The market movements we are currently observing are a direct result of powerful economic forces and shifting investor sentiment a natural, albeit painful, market correction. They are not the precursor to some hidden imminent revaluation event. The most successful and sustainable approach to investing has always been one that is grounded in verifiable data and a thorough understanding of macroeconomic trends, not one based on speculation and unverified online rumors. Grasping the intricate interplay between global interest rates, energy markets, and international trade flows will always be a far more valuable and reliable tool for any investor. Looking toward the remainder of 2025, a consensus is forming among many market analysts that volatility is likely to remain a defining characteristic of the currency markets. The same powerful global forces that precipitated this initial drop, namely a strong US dollar, unpredictable oil prices, and realigning global trade balances, are not expected to dissipate in the near future. This means that both Iraq and Vietnam will need to navigate this challenging global environment with exceptional skill and foresight. Their ability to adapt will be a key determinant of their currency's performance in the months and years to come. For Iraq, the path forward will require a renewed and determined push for deep financial reforms, aimed at increasing transparency and reducing corruption, alongside a serious long-term strategy to diversify its economy beyond its heavy reliance on oil. For Vietnam, the primary challenge will be to skillfully manage domestic inflation without derailing the foreign investment that is so crucial to its continued growth. Both of these paths are fraught with difficulty and are achievable only through sustained effort over a prolonged period. Investors should therefore prepare for a journey of continued ups and downs before any meaningful and lasting recovery can take hold. In conclusion, the currency shock of 2025 has undeniably sent a wave of anxiety through global markets, leaving many investors justifiably concerned about the value of their holdings in the Iraqi dinar and Vietnamese dong. However, it is imperative to remember that panic is never a viable strategy. When viewed with the proper perspective, this significant downturn can be seen as either a painful financial lesson or a valuable opportunity to learn and recalibrate, depending entirely on one's response. The most prudent course of action is to maintain a disciplined strategy, anchor expectations in realism, and keep emotional reactions in check. Ultimately, knowledge and patience are the most powerful assets any investor can possess in times of such profound market turbulence.